When a consumer hits send on their smartphone, the interface makes it look like money travels instantly. A quick tap, a green checkmark, and the transaction feels finalized. Behind the screen, that cross-border transfer navigates legacy rails like the SWIFT network, bouncing between disconnected correspondent banks. Each stop introduces opacity. The receiving bank must verify the sender's bank, requiring a third intermediary that adds fees and stretches settlement times into days. Global commerce is currently running on analog routing infrastructure designed in the 1970s. Public attention has spent the last decade fixed on the volatile price swings of retail crypto tokens and speculative decentralized finance protocols. While retail traders were chasing meme coins, traditional incumbents were focused elsewhere. Inside major financial institutions, like this Visa headquarters, teams were adapting blockchain technology to upgrade their own settlement operations. 2026 marked the point where these experimental programs moved into production, with live institutional capital replacing legacy financial plumbing. To see where global finance is heading, we have to look past the speculative tokens and examine the architecture of the newly constructed financial stack. This 3D diagram shows the new economic architecture. At the bedrock, we have central bank digital currencies, or CBDCs. Major economies are specifically building wholesale CBDCs. These are interbank settlement tools, connecting massive institutional nodes rather than tracking individual consumer spending. Wholesale CBDCs allow for atomic cross-border transfers with zero commercial credit risk because they are direct liabilities of the central bank. These digital tokens are replacing the slow-moving reserve accounts banks have traditionally held at central banks. Establishing this programmable, zero-risk foundation is the prerequisite for upgrading the rest of the commercial economy. Moving up the stack, we reach the commercial layer. Here, businesses and corporate treasuries operate. In 2025, the passage of the Genius Act provided the legal framework for this layer, setting strict rules for reserves and allowing institutions to deploy digital assets with regulatory certainty. This layer uses two main tools. First are payment stablecoins, fiat-backed assets that enable near-instant, borderless B2B payments for global vendors. Second are tokenized deposits. These digitize traditional bank accounts, allowing corporations to earn yield and keep FDIC insurance while moving money on blockchain rails. For a global company, this layer eliminates foreign exchange exposure and allows for real-time treasury management. These tools rewrite how corporations manage daily capital, replacing delayed batch processing with continuous, programmable liquidity. If these private bank ledgers and public blockchains cannot communicate, the friction of the old system simply migrates into the digital world. Interoperability protocols like the Regulated Liability Network act as the smart glue that bridges these disparate layers. This allows a tokenized security on a public network to settle simultaneously against a wholesale CBDC on a private bank ledger. By connecting these silos, interoperability protocols transform isolated ledgers into a unified global financial operating system. Traditional incumbents have now fully integrated stablecoins into their native settlement architectures, but turning money into software creates a massive systemic vulnerability: smart contract failure. The financial stakes are high. In 2024, nearly $250 million was lost to smart contract exploits, primarily due to logic errors in the code. In a system where code executes automatically, a single accounting bug in the financial plumbing can trigger a chain reaction of losses before a human can intervene. A logic error in the dollar's code creates a crisis that moves faster than any regulator can react, bypassing traditional economic safeguards. To mitigate these risks, 2026 financial institutions are building preemptive recovery architectures and AI-driven threat detection. Dashboards now use real-time on-chain forensics to flag anomalies, with circuit breakers capable of freezing specific transaction paths instantly. Legal backstops are catching up as well. The UK Property Act of 2025 created a clear category for digital assets, ensuring disputes in the code can be resolved in traditional courtrooms. Central bankers are operating as chief architects, managing the complex financial ecosystem through the code itself, rather than just interest rates. Future monetary policy will be written in the elegant lines of code running the world's financial operating system.